Welcome to The Explainer. Today, we're decoding the actual math behind true long-term stock growth. Let's dive in.
Ever wonder why Wall Street's short-term price targets usually fail? It's because they're just guessing temporary market feelings.
Short-term targets rely on pure hype, but over the long run, stock prices strictly follow real earnings growth. So here's the three-step logic. Estimate 2030 earnings, apply historic multiple, and calculate your target. Simple.
Take Microsoft. Their stock tanked 21% last year, even though their actual earnings kept right on growing. Why? They're spending heavily on future growth, capital expenditures, which temporarily crushes their free cash flow today.
But look ahead. Analysts project Microsoft's 2030 earnings per share will absolutely explode to $33 and change.
Apply a conservative historical multiple to those earnings and boom, the math points to a doubled investment.
Meta took a similar 17% hit recently. The market punished them for making the exact same strategic investments.
But ignore that short-term pullback. Meta's actual long-term earnings are projected to surge nearly 19% annually.
Even if their valuation stays historically cheap, that insane earnings growth still models out a $1,200 target. Now, UnitedHealth, they face some political drama and elevated medical costs lately, which completely spooked short-term investors.
But the long-term math? It shows their earnings recovering incredibly well, compounding at 21% a year.
That recovery easily models an $859 target, plus you get a really solid starting dividend yield. Finally, we have Accenture. They suffered a totally brutal 58% share price collapse this past year. Investors absolutely panicked, crushing the multiple. It's now trading at historically cheap, almost unbelievable valuation levels. Basically, the market has completely priced in a 9% annual drop in future free cash flow.
But reality check, the actual business math shows growing cash flow, rising earnings, and a super strong dividend. Assuming just a tiny bounce back to average, we get a $280 target. That literally doubles your money.
So, by ignoring the temporary noise and trusting that long-term earnings math, some truly incredible compounding opportunities appear. I'll leave you with this. Are you just chasing short-term sentiment or investing in true long-term earnings growth?